Hi, I'm Peter Rose, founder of Longwood Currency Trading. I'd like to talk to you a little bit today about fail fast, fail often. It has to do with a software engineering concept that, as a software engineer for 33 years. And so I'd like to talk about how that concept applies to trading. But it's such a wonderful day out, I've decided that I'm going to take a short walk up through the loop in the woods and just chat a little bit about fail fast, fail often. So as I said, it's a really nice day. It's been cloudy, overcast, rainy, drizzly, typical New England. This is the middle of June, actually last week of June, right? And we've just had weather that is not, it's not summer. And yesterday, or the other day, the 21st of June, summer solstice, and we're just seeing it today. In software engineering, there's a concept called fail fast. And what that means is that as you're writing a computer application, you want to trap as many of the results, as many of the problems up front, rather than letting them propagate through the system. So for example, if you're taking in a person's birthday, you're registering an employee and you need to know their birthday, okay? There's a certain format that birth date needs to be in order to be consistent across all of the data in the database. And so if the person enters the birth date wrong on the entry screen, you want to trap that right away. You don't want to let that propagate through into the system, so that every step of the way when you're going to use the birthday, you got to check it, make sure that it's the correct format. I mean, that's pretty evident, right? Not so evident in trading, and that's why I want to relate this stuff to stuff that we do know that works. I mean, I was a software engineer, like I said, for 33 years, so this was one of the main concerns. Fail fast. In fact, that was the term that was used specifically for the method that was called when a problem like that would occur. You'd fail fast. And what that meant was you would send the user back to the screen where he was inputting the data and say, hey, dumbass, you look at the directions on the screen, you got to input your birth date in the correct format. It's got to be not the way that you did it. Fail fast. And fail often in the beginning, because you don't want to, again, propagate that stuff forward. In trading, what do we have? We have a stop loss. That's fail fast. If that position goes against you, you get out because you don't know how far it's going to go against you. Because I'm a day trader, my stop is 8-10 pips. Because 2 pips, look, if you made 3 pips a day, 5 days a week, that's 60 pips a month. Now you do the math on that. If you're trading a 1 lot, that's $600. If you're trading a 10 lot, it's $6,000. So 3 pips is a lot. So to let your stop sit at 20 pips or 50 pips, or to give the price what? Room to breathe? Why? Fail fast. Because you made a mistake. You didn't enter the trade to have it go against you. You entered the trade because your trade entry analysis indicated to you that the price was going to move, let's say, up. Well, guess what? It's a 50-50 jump ball whether it's going to move up or down on the next couple of ticks. But how many ticks are you going to let it go? How many pips are you going to let it go before you go, oh man, maybe it's just not going to go there? How many? 20? 8 to 10. Get out. Oh, but I'm going to lose 8 or 10 pips. That's the problem. You don't understand fail fast and fail often. What difference does it make if I fail 3 times in a row at 8 pips? That's 24 pips I've lost. And then I get on board and it goes and it does my 30 pip run. Well, I didn't make very many pips. As a result of that, I won 30 and I made 30 and I lost 24. But I'm ahead by 6 pips. And so you have to look at your trading as controlling the only thing that you have control over, which is your risk. You know, unfortunately, the educational methodology out there is a set and forget, to trade on the daily charts because you got to go to work, and so you do the 5 o'clock candle close, and you set it, and then you go to work the next day, and 5 o'clock the next day you look at it again. Or maybe you want to do it at the beginning of the day, at you know, when you get up in the morning, you look at the situation and you go in. Well, how many times are you going to have opportunities to make trades based on that? You know, I mean, it's not very many. And so the theory is, you trade on that daily chart, you just let price do what it's going to do. Well, what it's going to do, you have no control over as far as the amount of money it's going to make. How many times are you going to get it wrong at a 50 pip stop or a 100 pip stop? What are you going to, you got to give price room to breathe? How much breathing room do you need before the thing chokes you out? And the problem with that education is, though someone may know how to do something, doesn't necessarily indicate that they know how to teach it. And that's where all these rules, the 2%, don't lose more than 2% of your account, or 1/4% of your account. Somebody that's trading $400,000 or $500,000 accounts doesn't worry about losing 1/4% on their account, because they're only going to lose it a couple of times, and then their win-to-loss ratio will give you more than ample to make that up. So why is that being propagated? What, you're not focusing on the thing that's the easiest thing to focus on, which is your risk. And the only time you notice your risk is right away. What do you want to do? You want to be driving through an intersection and have a delayed light, and you get plowed into? You want that light to change, and you want to stop right away. You don't want to just keep on going. What are you going to do? Well, I don't believe the light. The light's red, it means stop. So when certain things happen to price, it indicates that maybe it's not going to continue going forward. What's the thing I have control over? It's to get out. It's to fail fast. Oh, I could do that on a daily chart. No, you can't. Well, when you're looking at a daily chart, what are you going to see? You're going to see the 10 pip move or the 20 pip move against you. But because you've been taught to give your price room to breathe, you're going to let it go. How far are you going to let it go? What's your emotional capability to cut that price loss, cut that price short and get out if you don't have any experience in losing? The whole point of fail fast in software engineering is to write code so that you trap all those problems that could occur right up front, and do it often. They call the view part of the application is the transfer of information from the screen, from the data screen, onto the controller, and managing that input data. That's the layer of the application that you want to do or to use in order to trap all those user errors. And so the entry phase of the life cycle of a currency pair is where you want to trap all those errors. You want to get out. You want to fail all the time. So if you're doing entry analysis, and again, the software, the life cycle of a currency position, which is entry analysis, position management, and exit methodology, is a term that I came up with out of the software engineering world of a software development methodology. Because it works. You break a problem down into logical phases and solve the problems, each one of those phases. You write 1 or 2 rules for each phase. It's a little more complicated in software engineering than it is in trading. So, you know, trust me when I tell you that I've made my trading simple. I've got 3 rules. That's it. For the whole thing. Now, they're not specific rules. They're generic rules which allow me the ability to work my trade the same way you would drive a car between the 2 white lines. You're not driving on the white line. You're driving between the 2 white lines. So you have some flexibility. Not much, but a little. and it'll get you where you need to get to. And that's what a rule should do in any event. If you can solve the problem up front of your risk management, then you never have to worry about it again. And that's why I have a very simple system. I solve the problems of the risk management up front. Because I know when I get into the position management phase, there is a rule that guides fail fast and fail often if certain conditions present themselves in the price action that I'm watching. And I'm not watching it on a daily chart. I'm watching it on a 5-minute chart. And if it starts to fail, or down on a 1-minute chart, it starts to fail, I get out. And I preserve an enormous amount of the profit that I had. And you say, oh, that's great. Well, if I didn't get out and it went 30 pips against me, 3 pips is a lot of money on a daily basis. 30 pips is catastrophic. That's 10 days of 3-pip trading that you're going to have to make up. 30 pips is a lot of pips to lose. So you cut it short. But what you'll say, well, what happens? You're on this 5-minute chart. Well, what happens if it flutters a little bit and it goes down like 5 pips and it goes 10 pips and you get out and then it turns around and it continues to go up? I'll get back in. I have 12 opportunities an hour on a 5-minute chart in order to make a trading decision, either to enter or to get out. In fact, I don't wait for 5 minutes to determine if I'm going to get out. I'm looking at the 1-minute chart. Sometimes I'll look at the 5-second chart. Why would you do that? Because what happens on the 1-minute chart, it's 60 1-minute candles in an hour. I'm not going to wait for an hour to say, oh, I got a 40 pip pin bar here. I should have got out. I can see the price action beginning to decay on that 1-minute chart. So I go 4 minutes and price is moving against me. That's 8 pips. 1-minute bar. I'm talking about the major currency pairs. If you're doing crosses and exotics, I can't help you. But you have a 5-minute chart. It's got somewhere around a 5-period ATR, and the 1-minute chart might have a 2.5 pip or so ATR. And so I wait 3 minutes, and I see decay of 3 times 2, 6, 8 pips. I'm out. If I was wrong and the thing turns around and continues, I do a re-trade entry analysis and I can get back in. Because again, I've got 12 opportunities an hour to do that. I look at the 5-minute chart and I consult the 15 and the 4-hour. And the rules are very simple. And they keep you out of trouble. Now, the reason that I have some large losses is because of my 40 years in the real estate investment market, where you don't fail fast and fail often, right? You buy a piece of real estate and you're there for the long haul. I've held pieces of real estate for over 20 years. I let the compounding clock and the risk management work in my favor instead of working against me. Why should I have that? Why should I be trading real estate like a buffoon? You're going to do flips. Oh, that's great. That works out great until the market changes and you can't get out of your flips, and you've got 3 or 4 buildings going and you've got $700,000 or $800,000 tied up in buildings that aren't going to sell. And you're either paying interest to your investor, or you're laying down money to the bank. And if the banks get nervous, they can call your loan. You want to be in that deal? I don't think so. However, being an expert in risk management in real estate doesn't translate into the currency markets. And so my problem in experimenting and trying to find rules and stuff and pushing the boundaries on what I'm able to do sometimes causes catastrophic loss, because the real estate thing kicks in. It's such a big loss that I say my whole spirit, everything has bound up on me, and I hold too long. And all of a sudden I find myself 300 or 400 pips underwater on a big position. And I'm going, okay, well, I'm just going to hold this now, because in the long run, I think. And, you know, that's just the kiss of death, because eventually it'll kill an account. When I'm cooking and I'm applying the rules correctly and not making opinions of what's going to happen or what could happen or what should happen, I make a lot of money. This is 2023, late June of 2023, and last year I had 3 months where I made $30,000. $30,000 in a month. Now, maybe some other guys making $30,000 a day. That's great. I'm trading a six-figure account. I don't know what they're doing. I'm using reasonable leverage. They're using 200 to 1. They don't know what they're doing. So that's where they come up with the stupid quarter of a percent risk against your bank, because they're at 200 to 1. You're going to lose it all immediately. And a lot of them do. A lot of them go broke because they really don't understand what they're doing. And they don't have a set of rules. Me, I've got a set of rules, but they're foundation on risk management rules in real estate, unfortunately. Some of those transfer through, but it's the when component. You know, I've always said that in the big picture of things, I'm turning around here, sorry if I'm making you dizzy. In the big picture of things, currencies aren't real estate. The when component is totally different. And I'm having trouble making that transition. When I get it right, I make a lot of money. And I got a good win-to-loss ratio, and I can make a lot of money. So all I'm trying to say here is that critical to your understanding is fail fast and fail often. If you learn how to fail fast and fail often, you'll get used to failing, and it's not gonna affect you. You fail fast and fail often in your entry, and you get out. If you're failing too many times, it's not because your stop is too short, it's because you don't know what you're doing. You're not doing the entry analysis correctly. That's why the bulk of the coursework and the analysis and stuff that I teach is around entry analysis, because if you can get the entry analysis right, and it's the hardest to get right because there's this emotional component in it, then the other two phases are relatively simple. Position management and exit methodology. If you don't mind taking a loss, you're a lot better off having lost many times a small amount, because then you'll take the position will be running and you'll take that loss, and it'll go back and it'll move in the direction that you wanted to go in, and you get back in and it turns against you and you get out, and you get back in and it turns against you and you get out, and it turns and it goes again and you get back in and it's gone, and now it's on a big run. And yes, if you would have stayed there, you wouldn't have lost all those pips in the getting in and getting out, but you'll more than make up for them if you understand how to manage a position. Trading, you have to be an expert in all three aspects of that life cycle of a currency pair: entry analysis, position management, and exit methodology. You have to be an expert in all that stuff. Now, that sounds pretty daunting, and it is if you're trying to read a book or listen to the videos and stuff. But if you do what I did, which is step back from things and look at it. I mean, I lost $40,000 when I had my first large account that I opened and went live. I thought I had it all down. I've been trading at a demo account, making 15% a month. No problem. I get in a live account, 40,000 gone. Why? It's because of the education. It's not presented correctly. And a lot of it is, though it might be good information, is presented in the wrong order. That when component. What do I need to do? How do I need to do something? And when do I do it? If you don't have the when part, you're not going to get it. So those are the things that I learned in my physics background, my software engineering background, my 40 years in real estate, over 50 years in martial arts, teaching people. I'm an expert educator, teaching people how to survive, to manage their lives. In currency trading, teaching people to survive with their financial situation. And in currency trading, one of the concepts from my software engineering background of fail fast, fail often is critical in your understanding and acceptance of loss. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.